All right. And welcome everybody. Again, I'm thrilled to have so many people on the quarterly call. I think you're going to find we have a lot of good information, and I've actually have a pretty good presentation, so I think you'll like it. Before we get too far down the road, though, I'm going to turn it over to Drew. She just has a couple of, it's not a whole lot going on, I don't think, over in client service, but she just wanted to talk a little bit. She had a couple of things. So Drew, why don't you take it away, and then we'll get started with the presentation.
All right. Hi, everyone. It's great to see you guys and hope you're all enjoying your summer. I just wanted to start off the call with an exciting announcement. Don has a new website that just launched. He's been working with a marketing firm over the past few months, and we're really happy with how it turned out. So I'm going to share my screen here and show you guys. So all you're going to do is go into your browser and type in pciatampa.com. This is the main page right here. And what will be most beneficial for you guys as existing clients, right up here in the right, if you click on this client login, we have some quick links if you do ever need them to get into your Charles Schwab account, and then also Orion. And with that, if anybody still needs help getting their Orion login set up for, it's just our new client portal, please feel free to reach out to either myself or Dawn, and we will be more than happy to help you. So with that, I'll pass things on to Dawn. I'll stop sharing my screen.
Great. Thank you, Drew. And yeah, I obviously, I think well, first of all, Orion has been a great tool. And I encourage everybody, if you haven't, to get in there. All of your account performance, there's a document vault, which makes it easier for us to send each other documents more securely. I'll probably start putting the monthly videos, the quarterly calls up there. But the main reason I did this is actually because of you. You guys are by far my greatest source of new clients. You refer friends and family, for which I can't tell you how grateful for that I am. And I noticed pretty quickly that if you wanted to tell somebody about me, and most people like to look things up on the internet, it takes them to the Prime Capital website, which nothing against their website, but it's pretty hard to find anything about Don Williams. So this is a great way if you just want to say, hey, just take a look at what he does, and his feed schedule's on there. You can take a look at it. And so as I say, one of the main reasons I did this was to make it a little bit easier for you guys to share me. That is, if I'm doing a good job, which hopefully, as we show you today, we're doing a good job. So let me take my little note down. I'm going to start off a little differently, and I want to start off with a poll. And I'm going to tell you, this is the first time I've run a poll. So let me see if this works here. So first question is, which market risk are you most concerned about for the remainder of the year? Multiple choices. So if on your screen, you should, are you seeing that, Drew? Yeah, it's up there. It looks like they're both up there. Okay. So that kind of gives it away that my second polling question, which is, do you think inflation will be a short-term or a long-term problem? So if everybody can go ahead and answer those, that would be great. We'll just give it a couple of seconds, and we'll see what the results are. Looks like we've had 5. Oh, here we go. About 8 out of 16. We're about 50%. Gotta figure out how to do those polling questions separately. I didn't mean to have them at the same time. All right. We'll give it another few seconds. We got just about 3 people. We got 81% of the people in. I'll go ahead and end the polling here. Looks like everybody's in. I'm going to go ahead and share the results. So which market risk are you most concerned about for the remainder of the year? Looks like it was pretty evenly split between higher taxes and inflation, which is interesting. And that was followed by market valuations too high. So the good thing is, actually, I'm going to spend a lot of time or a lot of the call talking about inflation today. As you know, I was up in Ohio for about a month. I was working on I call it a home improvement project, which was some shoreline erosion control we were doing. And I sent the what's on your mind question out. Pretty much everybody came back with inflation. And since I was already going to do a deep dive in this call, I just decided not to do this separate video. So I think we're going to address that today. The higher taxes, I am probably going to get back with you on that. I'm looking to possibly bring a CPA on, or two maybe, and do a call where they can talk about some tax related issues. I want to hold off on that until we know a little bit more. Right now, we know taxes are probably going up. We just don't know how much or on whom. So those are two great topics. On the second one, do you think inflation will be a short-term or a long-term problem? Interesting. It looks like the slight majority of people, it's pretty evenly split again, but the slight majority think it'll be short-term, while the remainder are long-term. And hopefully we're going to help to address that for you today, because that is the big question right now. Certainly nobody knows. There's a number of factors that could contribute to that. I have literally been on 3 or 4 investment outlook calls with some from various mutual fund firms, investment firms, American Century, Hartford, JP Morgan, and even this morning I was on with Ned Davis Research. Everybody is talking about inflation. Everybody is concerned about it. Most people, the professionals, are going to be kind of much in the camp that I'm going to lay out here, or maybe I should say I'm going to lay out the most common answer that I heard from these professionals. So very good. So that was kind of fun. I'm going to close that out, and let's go ahead. I think now we can go ahead and do the share screen, and I will get the presentation up on the screen here. Drew, if you can just let me know, is that now full screen for everybody?
Yes.
Okay, great. If anybody has any trouble seeing anything, please don't hesitate to unmute and ask a question, or just let us know if you're having trouble as we go through it, just so we get through there. So let's go ahead and jump into this, and let me make sure I get everything. Yep, I do. So, all right. I thought I clicked the button. There we go. So let's talk a little bit about inflation. One of the questions that I did get from at least a couple of people was a definition of inflation. And I think less the actual definition and more, can you explain how they calculated inflation or the CPI back in the 70s, and how they compare that to how they calculate it today? And I have to be honest with everybody, I barely passed Macroeconomics 200. In fact, I think I had to take it twice. It's difficult, and I don't want to bore people with a lot of those details on how they calculate it. It is true that the Federal Reserve and the people that do calculate the CPI have changed the calculation by using things such as substitution and the durability of certain goods or the quality of certain goods in an effort to try to understate inflation. Nobody in the federal government benefits if inflation is higher, although I'm going to kind of make a corollary or a contrary to that argument. But there's certainly some people who don't want higher interest rates or higher inflation as a result. So it is kind of in their best interest to understate it if they can. But let me give a quick definition, and then I'll kind of move on. Inflation is the decline of purchasing power of a given currency over time. It's a quantitative estimate of the rate at which the decline in purchasing power occurs, and it can be reflected in an increase in the average price level of a basket of selected goods and services in an economy over time. And the term I want to emphasize there is the basket of selected goods. That's what most people are arguing about today, is they change that basket. Well, I put the Dilbert cartoon up here for two reasons. One, I love Dilbert. And two, I think it's really appropriate to the conversation, and why I think people might be kind of a little off message on it. And if you can't see it on the screen, I'm going to go ahead and read it. So Dilbert says, at the current rate of inflation, with no raises or promotions, our net worth at retirement will be a shopping cart full of aluminum cans. We better do something. His colleague says, I'm going shopping before all the good carts are gone. It kind of makes the point. I think people are focusing on the basket rather than the inflation, and that's not really the key. Of course, there's inflation. We know inflation's going up. It doesn't matter whether or not people are understating it. We simply have to make sure that we're defending against it. So hopefully that definition of inflation is at least a good primer. I think a picture is worth 1,000 words. So I think the simplest way to explain inflation is it's erosion. It's erosion of your purchasing power. And hence, I get to show you my summer home improvement project. So this is actually a picture of the cliff on my house in Ohio. This is Lake Erie over here. And the interesting thing that you see if we get the laser pointer up here, is that, as you can see, when the lake's fairly calm, the water's just sitting down there. But when we get 5 or 6 foot waves that come in after a nor'easter, these things slam up against the cliff here, and you can literally see how the cliff is eroded out here. Now, this picture was taken by my neighbor. I didn't even know it was going on. It's when he brought it to my attention that they were going to put some shoreline control, erosion control in there. And that's the thing. That's the thing with inflation. You don't often know that it's happening, but it is slowly eroding your property. Just as the water is here, until, one day these 2 trees fall over in the lake and I go, whoa, I got a problem. Again, picture's worth 1,000 words. So what do you do about it? Well, you put in riprap, which is what we did. I sent some people some video of the project. It was unbelievable. These stones are massive. They're 3 to 5 ton stones each. It took a massive excavator to put them in place. And I've kind of named these rocks, as you can see coming up on the screen here. Because think of these rocks as the various components in your portfolio that we have for you. Inflation, which is the biggest one of these, equities, which is the biggest rock here. Stocks are probably the best defense against inflation, followed by real estate, and then treasury inflation or inflation adjusted securities. These 3 rocks, if you will, or pieces of your portfolio, have been in place for months or years. We've had those in there. Now, recently we added the DWS REEF Real Asset Fund, which brought in some commodities, gold, silver, and basic commodities and commodity stocks, so stocks in those companies. And if things progress even more, in other words, if inflation does not subside or is not transitory the way the Fed believes it will be, and it ultimately raises interest rates, we will start to bring in alternative bond vehicles such as CLOs, collateralized loan obligations, to the portfolio. So the point I want to make is, inflation's here. There's no doubt about that. We can debate whether it's going to be short-term or long-term, but you have a defense in your account right now to guard against that. And I don't know how many watched the video with Chris Bouffard. We had a conversation about this. I thought a very good conversation. And he also, kind of supported the idea that if you do have additional cash, and a lot of people do because of for a variety of reasons. COVID, of course, and not being able to go out and spend. There's nothing wrong with going out and buying some gold or buying a cryptocurrency if you understand it. Those will help in defending against more inflation. But you've already got the rocks in place. So let's move on to the macroeconomic review. And again, I try not to give the illustration or illusion of any plagiarism. The slides I'm presenting have come from a variety of the decks from the calls that I was on. And so I think most of them came from the JP Morgan deck and some from American Century, which were very good. Drew, I think it was American Century is the only one that bought us lunch the one day, though, wasn't it? So that was actually a good call. Yes. But which is great when you have to listen to portfolio managers talk about inflation. So let's talk about the economy and how's the economy doing. It's no surprise to anybody that COVID, the pandemic, killed the consumer, both figuratively and tragically, literally. And consumption makes up the largest percentage, over 2/3 of GDP or gross domestic product. So when the consumer shut down, the economy took a steep dive off of its normal growth trend. If the good news, if you will, as soon as the pandemic started to wane and things started to open up, the economy snapped back fairly quickly. This is as of the end of first quarter. We haven't gotten our June or second quarter GDP data yet, or at least it didn't hit the deck in time. But I think their estimate is to put GDP somewhere back slightly above the level of where we were, but not back yet to the trend level of where we were. We still have a ways to go there. But definitely things are coming back from an economic perspective. And that's largely because two things. One, COVID itself, it looks like, is dying. The number of the 7-day moving average rate of change of confirmed cases and fatalities in the US has fallen back to a level that is close to almost the beginning of the pandemic. That's good. We know there are some of these variants out there that are happening. We don't know quite how that's going to impact things yet, but I think the really positive sign here is that when you look at the progress to herd immunity, the people who have gotten vaccinated, and they're, certainly, I think the United States leads the world in the speed of vaccinations, not to mention the development of vaccinations. And then you add on the people that actually got infected with the virus, in addition to the people who were infected and then got vaccinated, which I'm not quite sure I understand that, but that's probably a topic for another call. But the key is that we're starting or have reached that zone where herd immunity, meaning that this can truly not be a major issue out there. If certainly our talking heads and politicians would get up to speed with the data. Speaking of data, the high frequency economic data has also shown a significant snapback. What we look at here are things like, well, first of all, the most devastated during the pandemic were TSA traveler traffic, people flying, and diners. Restaurants were completely closed down. Those have gone from completely, shut down to nearly back to where they were before the pandemic began. Hotel occupancy with people traveling is starting to pick back up. And then probably no surprise, again, the consumers come back very strong. Consumer use of debit and credit card transactions is actually higher than it was before the pandemic. Of course, people have money, stimulus, savings, back to work, et cetera. And then this last number is purchase mortgage applications, which we're going to talk about the jump in housing prices in a moment as well. So it looks like people are getting back to normal in terms of most of the economic data that we keep an eye on. That, of course, is real-time or historic data. What we really want to know is future looking data. So we go to our best friend, the best leading economic indicator that we have, which is the Purchasing Managers Index. For those that may not have heard it before, this is a survey that is done of purchasing managers of very large corporations, and it asks them 6 to 12 months from now, do you think you're going to be buying more, buying less, or buying the same goods that you did, are now or were? And if this is positive, meaning they're saying they are going to be buying more, then that means that the economy is expanding. So, obviously it's a very strong reading, both on the manufacturer and the services side, which leads us to believe that at least probably for the next 6 months to 12 months, we should continue to see GDP expansion, economic earnings numbers getting better as the economy continues to reopen. Probably no better example of the heating up of the economy has been this housing boom. Chris Bouffard dubbed it housing boom 2.0. For those of us in Florida, we certainly knew all about the housing boom 1.0. And in fact, I was at dinner last night, sitting at the bar, and a guy next to me happened to be a guy in real estate. We were talking quite a bit about this, and I was talking about the dramatic rise in home prices, up 24% in the last year. And this is, I point this out, this is the highest rate of increase in history, even surpassing the price boom in the late 1940s and 1950s when GIs were coming back from World War II. So this is no insignificant piece of data that we're seeing here. Now, again, I asked the guy, is this just another boom? And he said, no. He said, I do think that prices may continue higher for a little while. Eventually they're going to pull back, but he doesn't feel that there will be a crash the way there was before, for a variety of reasons. One, this isn't really a speculative bubble at this point. Two, the banks are much more cautious, as are the what's the word? The people who value the house. I'm having a blonde moment here. They do the valuation on the appraisals. So the appraisals are coming in realistic as well. So he said, look, I don't think that things are getting totally out of hand. But I think what we have here is that this is likely to continue on for a bit, because I think there's a demographic shift. The baby boomer generation is retiring. We know that. As they do so, they want to move to southern states where the climate is better. That's why I think Florida and Texas and Arizona have seen some of the most dramatic increases in home building and home prices. So we'll have to see whether or not that comes back and how sharply it does. Why is it relevant? Well, I guess it's relevant if you want to sell your house, as a couple of my neighbors have actually done because of this. And certainly it's relevant if you want to buy a house, but I think it's relevant for one more reason. This argument about whether inflation is going to be transitory, as the Fed loves to say, which means it's going to spike up, but then it's going to come back down pretty quickly. I think the argument for it not being transitory, or for it being longer lasting, is in this data here. This chart shows two things. One was the home price index that we just really kind of illustrated there, the sharp price in homes. But on the left, or I should say the darker blue line, is the Case-Shiller CPI shelter index. Now, what the shelter index is it's sort of a combination of both home prices as well as what they call owner equivalent rents. So people who are renting, it builds in those costs into sort of the cost of living, if you will. And the reason I mention this is that this shelter index makes up a third of CPI. So it's a very, somebody can mute their line. I think I hear somebody in the background. So it makes up a third of the index. Drew, if you can figure out how to mute that, that'd be great. Thanks. And so you can notice that this lags. It typically lags anywhere from 6 months to a year, the home price index. So if that's the case, then what we would expect is that because of the home price increase, we would expect rents to continue higher for the next 6 to 12 months. And if that is a third of CPI, then most definitely inflation is going to remain elevated for some longer period of time. On to jobs, and this is sort of my second case for a little bit longer term as opposed to transitory inflation. One would think that if the economy is so booming, we're flying and we're eating and we're building houses and we're buying cars and all this stuff, that everybody would be busy working, and that's not what we see. The JOLTS data, which is job offering labor. I can never remember what JOLTS stand for. It doesn't matter. It's basically job openings or open positions out there, has spiked to a near all-time high. So how in the world can it be that we have the economy reopening in such a dramatic fashion, and yet so many companies are not able to fill jobs? Well, I think we know the answer to that. Uncle Sam. It seems that everybody is living off their good uncle. While a lot of states have stopped their unemployment programs, many states still have not. In fact, just today, I think they announced, or yesterday, they announced that now there's a $300 a month child care credit. So with the federal government out there paying people not to work, and I'm not trying to be cruel. I mean, it's a simple, logical human trait. If I can do nothing and collect money, or I can work my butt off and collect money, I think it's a logical choice what people would tend to do. I think that's causing a problem. It's causing a problem to this extent. I mention Ohio frequently. Up on the island there, up in the area where I live up there, it's largely a recreational area. And one of the biggest employers, Cedar Point Amusement Park, which is essentially Northern Ohio's version of Disney, is having such a hard time finding employees that they're now offering $20 an hour and a $1,000 signing bonus for people to cook French fries. Now, the problem with that is, it sounds like a good gig. I'm wondering if maybe I ought to get a summer job. But the problem with that is that all the other businesses in the area that want to hire, employees, they've got to at least try to come close to that or match that. Otherwise, they can't hire anybody. So what's happening to the cost of labor? And this is showing up also in the data. So yeah, sure, unemployment is coming down as a result of the reopening of the economy, but we're also seeing a fairly, and this isn't just because of COVID, this has been really about the past 2 or 3 years, we've seen a rise in wage growth as well. And I think that's going to continue as a result of what's been happening here with the federal assistance. In fact, I'm trying not to make things too political, but I think this is on purpose. I think it was Joyce Huang on American Century said, look, Democrats tend to favor labor over capital, whereas Republicans tend to favor capital over labor. And this kind of echoes that if you look back to the 80s, for example. But it's pretty clear that the Biden administration is going to continue a number of federal programs, and that's going to make the cost of labor more expensive. And again, the case against transitory inflation is the fact that it's hard to take money away from people. Once you pay people something, you can't just the next summer say, well, hey, COVID's kind of over and so's the labor shortage. So, now it's $10 an hour. It's probably going to be with us for a while. So this inflation has certainly become a very popular topic. Not only are you concerned about it, but a lot of people are. The number of monthly searches on Google for the word inflation has spiked to nearly 100,000. So a lot of people are thinking about it. When we look at the actual data, the consumer price index clearly shows the spike. I'm going to ignore core CPI because it includes most of the things that we enjoy, like food and energy and transportation. But general CPI or general inflation is 4.99%. And I think the June print, if I'm not mistaken, I don't know, it was the May or the June print, it's actually over 5. It's 5.47%. So there's no doubt that the inflation is here. the question is how long? And I'm going to get a little bit wonky over the next slide, so I'll give you a fair warning. I didn't know how to try to make the case for both sides of the argument without getting a little bit into the weeds here. But there's at the bottom of this chart, you can see what's called break-even inflation rate. And most financial professionals tend to look at this number, and I'm going to explain it in a moment. But if you look at this chart, you see the sloping downward declining trend line is basically showing the break-even rate short-term treasury to 10-year treasury down to the 30-year treasury. And basically what that's saying is it's making the case that the market thinks that inflation is transitory. It drops dramatically over the next year. So when you have this slope, that basically means that the market thinks that inflation will resume its sub 2.5% rate in the coming decades to come. So let's look at break even, and I think you'll understand this a little bit when you do the math, and I want to make an additional point on it. So what is the break even rate? Well, interest rates, and we're going to use kind of higher numbers. Let's think 1970s, 1980s numbers here. Nominal interest rate is essentially the rate that would be paid on, say, a 10-year treasury bond. That nominal rate is really made up of a couple of factors. The primary factor is the inflation rate. So if inflation is running at 5%, what that means is that they're paying you 8% and the inflation rate's 5%. Your real rate of interest, or your real interest rate after inflation, is 3%. So this break-even rate is effectively the real inflationary cost in there between interest earned and what you end up getting to keep. So why is this important? We'll look at today. Today, the 10-year nominal interest rate, or the nominal interest rate on the 10-year treasury, is 1.37%. When you look back at this chart and we look at the 10-year is right here at 2.37%. So do that equation, subtract 1.37 or subtract 2.36 from 1.37, you have a real rate of negative growth. In other words, you have a shrinkage of money. And again, that's interesting for a couple of reasons. I think most of us, probably without all that wonky technical jargon, would have known that if I'm sitting there earning nothing in the bank and inflation's out there, I'm actually safely losing money. But the point I want to make is I actually think that the Federal Reserve is doing this on purpose, or I might say that the government is doing this on purpose. This benefits the government. How? Well, we're sitting at 26, 28, $30 trillion in debt right now. When you have a negative real rate of return, that debt is becoming less of a burden to them. By that shrinking, it in fact means they owe us less of our money back. It's what they call monetizing the debt. And some people have asked me, one of the questions is, do you ever think that the United States will go to negative interest rates the way Europe has on some of their treasuries? And my answer is, why should they? They're already negative. They don't have to move this. In fact, the United States probably sees itself in a really great position. They can pay a globally competitive interest rate. Again, Europe pays negative interest rate to buy their bonds. We're the best deal in town, even though it's low. But because of inflation, they still get the benefit of monetizing the debt. So money will continue to flow in, and they won't have to pay as much of it back, which I think is probably a very good thing, because when you look at this chart, and I know it's busy, I'm going to talk to it a little bit here. This is the 2021 federal budget, the CBO forecast budget. And when you look at this, well, first of all, $7 trillion or something like that. You've got 20% of it is Medicare, Medicaid, 17% Social Security, and 11% is defense. So, well over a third of it is non-discretionary, if you will. Then we have non-defense discretionary, and then we have other, which is this whopping $2 trillion. Now, quite know what that is. I assume it is various stimulus stuff that has been done as a result of the pandemic. But when you look at how they funded that, 44% came from borrowing. So when you start thinking about that, this little equation back here gets rather interesting. The United States of America, if they're going to borrow that heavily, cannot afford for people to ever come to the conclusion that treasuries, are not worth what they're paying. Because what happens is typically in any normal environment, any normal business situation, if you are lending somebody money and you think that they're not maybe, in a good financial position, you charge them a lot of interest. The United States gets away with, in my opinion, having a pretty bad financial position and not having to pay a lot of interest. If that ever changes to a point where borrowers will no longer tolerate a low rate of interest, then let's say this goes back up to 5%, say, that causes all kinds of problems. Number one, it takes the 5% interest on the debt portion of the budget up to rivaling Social Security payments. And that starts crowding out this other stuff. I mean, we would be paying more for interest than we would be defense. Probably some people would say that's a good thing, but I'm not so sure. But it's a serious problem. Now, is it a problem that we need to worry about this year, next year, 5 years, 10 years from now? I don't know. I don't have any idea. I wish I did. Unfortunately, I don't have a crystal ball that's good. But I do know that I think a lot of what we're seeing in terms of the inflation that we're seeing, the policy prescriptions we're seeing from the administration, it's not by accident. With that, I think I will take just a quick pause. If anybody has any questions, Drew, did any chat questions come in? Certainly with 16 or 17 people, somebody must have asked a question.
We don't have any chats yet.
If you want to unmute yourself and ask a question, that's fine also. Otherwise, I'm going to make Drew ask me a question.
Can you hear me?
I can. Hey, Bill, how are you?
I'm doing fine. I don't know if this is the proper place in this conversation to ask the question, but I've been getting a ton of emails from nefarious sources about Biden's plans for our 401ks and what it's going to do with the tax. Do you have any information on that, and what should we do about it?
Sure. Yeah. And I'm certainly happy to have a longer conversation offline, Bill. Well, I'm going to say a couple of things. Number one, no matter who is the administration is, there will always be people out there that will try to scare you into doing something, whether it's buy gold, get rid of your 401k, buy an annuity, whatever. Fear mongering is just about as old as prostitution as far as a trade in humanity. So be careful with what you read. There is certainly some truth that people are concerned about the fact that with all this borrowing and with all this spending, they're ultimately going to have to raise taxes. In fact, Biden himself has said he's going to raise taxes. And so the question on 401ks or retirement accounts is really more a question of, if I deferred taxes now at a lower rate, thinking my rate would be even lower when I got to retirement, and all of a sudden they raise tax rates, and then in retirement I have to take the money out, would I have been better off taking the money sooner instead of delaying it? And that's a question, unfortunately, we don't know. And by the time we get there, there's not much we can do about it. You're certainly not going to convert all of your retirement, pre-tax retirement money to a Roth IRA and pay, 35% income tax rate. So that's not an option. But it's certainly for younger people, at least, really makes the case for Roth IRAs, or even for people who might for a few more years be able to convert to a Roth IRA. I definitely think that makes sense. I wouldn't give much credence to some of these emails that are out there that say, Biden's going to come take over or privatize people's IRAs and 401ks. There are some wacky ideas out there in Congress. Believe me, I've seen some of them. But don't forget, the financial services lobbying industry is probably one of the biggest, if not the biggest. They're not going to steal 401ks out of the hands of that industry without a fight. So I don't think that's going to happen.
Don, does this, what you just remarked on a while ago, does this say something about investing in bonds?
As far as investing in bonds?
Yes, I mean, after looking at inflation and how much percentage we're gaining, and
Sure,
could go to minus. So if you got a lump of money you're trying to put into the market, are you staying away from bonds?
well, we're certainly staying away from what I would say a passive strategy of bonds. Conservative investors, unfortunately, can't avoid fixed income altogether. Because, what are your choices? Put it in cash or put it in stocks? I mean, that's about it. So, bonds have to make up part of it. What I would, and this is also one of probably the most common topics that went along with the inflation question on the calls that I was in. After they were done explaining inflation, they said, well, what about bonds? And all of the people, especially the gal from American Century, stressed the fact that this is the time for active managed bonds. This is not a time to own a bond index or to be in the Vanguard bond. I'm not picking on Vanguard, but it's the biggest index company. To be in just a passively managed bond fund, because certainly as rates rise, as inflation gets bigger, all kinds of things in the yield curve could cause those bonds to become negative very quickly. So it doesn't mean you avoid them altogether. There are a lot of strategies that we can utilize, such as TIPS, Treasury Inflation, American Century. Actually, one of the funds in there is the American Century Inflation Adjusted Fund. There are collateralized loan obligations, which I'll explain offline if you want. But we have a lot of ways to be able to still keep things safe and generate some income without as much equity risk. Hopefully that answered the question. Let's go ahead and move on. We're about 15 minutes to the hour, and I don't want to go on too long past that. So let's take a look at the market. The market actually it has done very well for both the month, quarter, and year to date. Talking about bonds, when we look at the month of June, domestic bonds, both the U.S. aggregate or what we would call investment grade bonds, as well as high yield corporate bonds, posted positive returns for the month of June. The quarter showed positive returns, but the Barclays was actually negative for the year, while high yield bonds are still positive. And Richard, that's another area I didn't talk about. I'll mention near the end of this slide, this section, but high yield corporate bonds are another vehicle where, even though rates might go up and that has a deleterious effect on the price of bonds, with high yield corporates, they pay enough interest to overcome that principal erosion. And so we're seeing a lot of money flowing into high yield corporate bonds, which is sort of reflected in that, and I'll show you a chart of that as well. On the stock front, again, before I move on there, international bonds negative for the month and almost the quarter, but certainly for the year. We don't have any international bonds in our portfolio right now. However, if interest rates start to rise or if inflation continues this way, a lot of the fixed income folks were saying they are very bullish on international bonds for a variety of reasons. Lower valuation, less risk, greater spreads. And so my guess, I don't want to speak for the IAC, but I think we might be looking at that addition to the portfolio, maybe a few months from now. On the stock side, the U.S., large cap and small cap, positive for all three periods for the month, quarter, and year. What we see is that small caps, as we had talked about on our last call, definitely had a strong comeback over large cap stocks. It looks like that waned a little bit in the second quarter. The Russell 2000 was a little weaker than the S&P 500 for the quarter. and about the same for the month. International and developed markets, those areas which we are bullish on. And again, if we have a lot of inflationary pressures in the US, and with all the money printing that is going on, that makes a very bullish case for international, and I'm still bullish on it. The returns are not still yet quite as good as the US, but I think that's going to continue to get better. We did see in the month of June that there was negative return on international, and emerging markets were about flat. That's primarily due to a surge in the dollar. For whatever reason, in the month of June, we saw a pop in the otherwise declining dollar. The guy from Ned Davis Research this morning, Tim Hayes, indicated that he thought that was just sort of temporary, that the bear market in the dollar would continue. And again, that would give strength to the cause to stay in international and emerging markets. And of course, one of the inflation hedges, one of my rocks, if you will, real estate doing spectacular for the year. Our REITs are up 21.3% for the year, 12% in the quarter alone. It's been very good for inflation positions like real estate. And again, I know, Richard, you're getting out of real estate, but maybe getting back into real estate and something that's a little easier to manage. How's that? If you're a picture guy, the market carpet chart's another way to carpet chart is another way to view the data. And I don't need to say a whole lot on this, but we kind of see that pretty much throughout the year we've seen a typical balanced 60-40 portfolio generating about 1% a month, pretty consistently throughout the year. So again, we're seeing balanced portfolios up 6-7% year to date, which is great. Certainly making you happy, and that's right where they should be. Another bullish case for the market is we're seeing some of the most dramatic and continuing dramatic increases in the S&P 500 earnings estimates. We're right in the heat of things right now in earnings releases for second quarter. The banks have just kicked that off. We're going to continue to see more of that. Earnings surprises are up really about the highest that they have been. And if the leading economic indicator, the PMI, is correct, we should see this continue probably for another couple of quarters, would be my guess. So as long as earnings are good and surprise the market's probably going to continue to go up. However, seasonality suggests that the S&P 500 tends to move lower with higher volatility over the next few months. So as you can see, as we move into later July, August, September, the fall period, the market tends to, on average, this is what, a 30-year average, on average tends to be a little weaker, and volatility picks up during that period of time. Now, please don't misunderstand. I'm not suggesting, or I hope you won't call and say, hey, should I get out of cash and wait for this to pass? Of course, every year can be different than the trend. But what it means is we probably should be patient. I guess the reason I'm mentioning this is, the market's high, and the valuation of the market is high right now. But I think with a little bit of maybe sideways movement, even a small single-digit pullback in the market, along with improved earnings, the market valuation could get back into a place where we wouldn't be quite as nervous. And I think the PE ratio on the S&P right now is about 20, 21, something like that. So it's high. It's not crazy.com high, but I think that trend will continue to get a little bit more favorably valued if this chart is correct. If it is more, and I know a lot of you worry about this. In fact, Chris Bouffard and I talked about probably the biggest concern on investors' mind is, when's the party going to end? I think every professional investment advisor, CFA, portfolio manager, chief investment officer feels that we are in still a long-term secular bull market that started back as far back as 2009. They believe we'll continue to stay in this, that we're not on the precipice of a bear market. How do we know? Well, obviously, the prime folks have their own internal dashboard, but I wanted to kind of illustrate one. Citigroup has what they call a bear market checklist, where they look at a number of different items, such as investor sentiment, the valuation of the market, profitability of companies, the strength of balance sheets of companies, IPO releases, macroeconomic data, including various fixed income, credit, high yield credit spreads, the direction of the yield curve, et cetera. And they look at these and they have these indicators of where things are either cautious or in danger. Yellow is cautious, red is in danger. And you can see this is the 1990 market peak. Out of the 16 indicators at the time, 70% were flashing. That's obviously a danger zone. In 2000, we had 89% of the indicators were in a danger zone. And even 2007, 50, I think it was at 55%. Currently, with where the economy is at this point, only 35% of the indicators are in the danger zone. And most of those, in fact, the majority of them are in the market valuation category. So again, a single digit pullback in the market, improved earnings, and this valuation could come down and we could even be well below that. So I don't think we're on the precipice of a bear market right now. Obviously, we may see some volatility, but we don't think that the beginning of the end is nigh. I wanted to mention the high yield bond spread because that's another indicator. What are high yield bonds? High yield bonds are junk bonds. These are bonds that have low credit ratings, and people don't buy them if they think the economy is in bad shape. Well, people are piling into high yield bonds, so much so that the spread is down to a record low 3%. In fact, you can only get about on average 4% yield on a high yield bond. That's not a whole lot of premium to be buying junk bonds. So that's a good indicator that people are pretty confident that the economy is in decent shape for the time being. Obviously, if you're concerned about risk, and I think the takeaway from this quarter is going to be, I want to try to get people to engage with my my Riskalyze tool. Riskalyze is a company that has a risk assessment score, a risk assessment tool. It's based on behavioral finance. It allows us to quantify your risk profile in sort of a speed limit number. I can then take a look and see what your current portfolio is and make recommendations and proposals. So if you don't think you're where you should be, or you're thinking about you want to add a portfolio and you really want to, or you want to add some money to your portfolio and you really maybe want to take a little different risk, I'm going to encourage everybody to do this Riskalyze. I'll probably put a link to it on my website, or I'm going to try to get my tech guys to do that. But we're probably going to make this the push over the next month or so to have you go in, if you haven't already done it, and go through the questionnaire, the quiz, because it's really interesting. It's a lot better than the thing you had to fill out when you signed up. So the bottom line is right now, the path of least resistance for the market remains up. Risk assets have a number of tailwinds at their back, and barring any major wars, geopolitical events, we would guess that the market will continue higher for the near term, albeit we may see some volatility in the meantime. So I'm going to kind of wrap up here. I'm just I'll kind of just talk briefly about performance. Again, the 6-month period, year-to-date period, shows our ambassador models exceeding their risk-adjusted benchmarks in almost all categories, maybe trailing a little bit in the more aggressive categories. We're certainly seeing some good results in our satellite models. Many of you who are in the diversified income strategy, we're starting to see a little better traction and a little better performance in that model, primarily because the shift is really starting from growth, technology growth stocks into more value-oriented companies. I think that's got a long runway to go. So if you're looking for income in your portfolio and you aren't too wild about bonds, this diversified income strategy may be a good alternative for us to discuss. And I'll kind of maybe give that hint to Richard when we get offline. So our portfolios are looking very good. We're seeing positive returns across the board. So all in all, it looks like things are going well there. Well, Drew, I did all I could to keep it under an hour by 4 minutes. Why don't we go ahead and open it up and see if anybody does have any further questions? Had a couple of good questions. Do we have any other chat questions at this point?